Hello, I'm Katrina M. Craft, and you've just tuned into the Craft More Cash podcast, where finance meets innovation and strategy becomes reality. With over 2 decades navigating the twists and turns of accounting, tax, and business strategy, I've had the incredible opportunity to work with startups and Fortune 500 companies alike, crafting pathways for businesses to grow and thrive. I've tailored my expertise to serve the unique needs of industries ranging from real estate to creators to marketing and beyond. I'm on a mission to equip individuals with the financial savvy they need to succeed. Through my Wealth Intelligence course, I'm all about breaking down complex concepts into actionable strategies for business owners. Welcome to Craft More Cash. Let's make wealth building simple, fun, and effective. Ready to transform your financial journey? Hello, this is Katrina Craft. I'm excited to talk about tax season preparation tips. We're also going to go over different tax strategies that you can utilize this year. When we're talking about tax season, we're talking about looking at past activities. We are in the 2024 tax season, but that records information from 2023. Now we're going to also talk about things you can do as a deduction and tax strategies to implement in 2024 so that you have a full year of tax deductions. I want to give you a disclaimer that this information is provided for informational purposes only. Please consult with your financial advisor or your particular professional accountant, because each information and strategy that I'm giving may not apply to you. So make sure you do consult your specific advisor. Are you satisfied with the taxes you pay? Are you confident you're taking advantage of every available tax break? And are your tax and investment advisors giving you proactive advice for saving on taxes? Remember, I said 2024 tax return year, when we're talking about preparation, is based on last year's activities. So really, you needed proactive advice last year to impact your tax return that's going to be prepared this year. But we have time to impact your 2024 tax strategies now, and you'll have a full year, almost a full year, to implement these strategies. A Supreme Court justice said there is nothing wrong with the tax strategy to avoid the payment of taxes. So there's nothing wrong with knowing the code, knowing the tax code, so that you can avoid paying taxes. But what you need to know is you cannot hide. You cannot try to deceive and not use the code and use the appropriate tax strategies that the IRS has allowed to not pay taxes. So that is the difference. That's why it's important to really work with someone that is going to help you utilize the code to impact your taxes. Welcome, I'm Katrina Craft. I assist individuals with tax planning. I also mostly work with business owners to improve their revenue, improve their profitability, better manage your cash flow, and also we're using these business tax strategies to grow your wealth. I'm an entrepreneur at heart. I started working as an entrepreneur in 2002. I took the dive into entrepreneurship. I love it. And as an entrepreneur, I have various businesses. I have CM Craft PLLC, which is a certified public accounting firm. I also have Craft Entertainment CFO, which works mostly with creatives into entertainment industry, such as Grammy winners, New York Times bestsellers, best-selling authors, as I mentioned, as well as awards for actors and musicians all over. So also I have a course that I've created, and I'm a creator at heart as well, with education and information. And that is a wealth intelligence course. And it's for business owners who want to really understand how to use tax strategies to build wealth, understand how to project their cash flow better, understand projections and budgeting, and really how to grow their business and build their wealth. So today we're going to talk about the often overlooked business deductions, how to save tax money purchasing fixed assets. So why tax planning? Tax planning means looking forward to minimize your taxes, not just recording history. It is very important to understand that you need to plan in advance. So 2024, I'm now planning for what you're going to file when you file your 2025 in that 2025 tax filing year. We're looking ahead so that we can minimize what we need to file and we can really maximize our taxes. If you do not plan, that means you're just recording history. You're just recording what's already been done, and there is no tax planning that you have done and strategies. And that's what we want to make sure that we are doing. Strategies, we're planning ahead of time. We're going to talk about, can I take this business deduction? IRS has said a business deduction that you can take is when it's ordinary and necessary. Ordinary is common and accepted in your trade or business. Necessary, it's helpful and appropriate for your trade or business. So that really depends on facts and circumstances, because what's ordinary and necessary in your business may not be ordinary and necessary in someone else's business. I'll give you an example. If you are a football player, and then let's compare me, the accountant. A football player needs a personal trainer. He may need a personal chef. He may need special equipment for workout. That's a part of his job that makes it ordinary and necessary. But me as a CPA, if I want a chef, it may not be a tax deduction unless there's a special event going around why I'm having catering or a chef. I may not need a personal trainer. What's the business of me needing a personal trainer? That's personal health, personal fitness that is happening. That's not something that I need in my business. So that's the difference between ordinary and necessary. Is it something ordinarily people would pay for if that's their business? And is it necessary, helpful, and appropriate for your trade or business? So let's dive deeper into some areas of ordinary and necessary, and that's the home office. So the home office deduction, we're going to talk about internet, renting your home to your business, and turning your backyard oasis into a deduction. So home office tax deduction, it's allowed deduction in the business if you have net income. So that's what's important. If you are continually running a loss in your business, you will not be able to deduct a home office deduction each year that you have a loss. But if there's 1 year that you have a gain, you still want to track your home office deduction on your tax return, because the year that you have the gain, you will be able to capture those deductions or capture those expenses that you had in the year that you have a gain. So that's why it is important, even if you have no net income and you have a loss in your business, still report your home office so that it can carry forward when you do have a gain and you'll be able to take that deduction. So the requirements to take the home deduction is it's your principal place of business. So if you meet any one of these requirements, you're allowed to take a home office deduction. So don't be afraid to take the home office deduction. It's your principal place of business you regularly and exclusively use for administrative or management activities. That means if you have a physical location and you also have your home office, it is allowed, because what you would do is have regular and exclusive use for administrative. You do your management activities at your home. You do your accounting at your home. You may do other business type activities at your home that you do not do at your physical location. Let's say you have a storefront in a restaurant. Well, at the restaurant, you do the sales and you do certain activities, but make sure that at your home, you're doing activities that you would not do in the store. That's the difference. You're also able to meet customers or clients at your home. So if you only meet your clients and customers at your home, so you got to meet any one of these requirements, then you would be allowed to do your home office. You store inventory of products and you use a separate structure on your property. So if you have a storage unit and you have different structure on your property and you have inventory of products maybe that you're storing, that is that's an area where it will allow you to do a home office deduction. Also, we talk about if you have, say, a garage and half of the garage or a portion of the garage is exclusively used for your business. Maybe you're storing materials, storing products. Make sure you take a picture of your home office. You never know when you're going to move. If the IRS audits you, you want to make sure you have captured your home office setting. Show that you have a section that's just for inventory if it's in your garage, products in your garage. Take a picture. In your home office space, make sure you're taking a picture of your setup, your desk, your computers, your file cabinets, and it doesn't have to be 100% of that office. So that office space could be half of the office, but make sure only that space, if it's just half of the room, is utilized for business. That includes your cabinetry. If you have cabinets that you've built and they're storing your materials, that counts. We talk about home office tax deductions. It could be actual costs or simplified method. So a lot of people have been scared to take the home office because they thought that it would make them be subject to an audit. Well, more companies that are Schedule Cs, that means you're filing as a sole proprietorship, are audited. So it's not necessarily the home office that could be triggering the audit. It could be that you're a Schedule C. That's why you may want to consider forming either C Corp, an S Corp, or an LLC, filing as a partnership. Or even if you're LLC, you can choose to be an S Corp or C Corp. An LLC allows you to select how you want to be taxed. An LLC is not really recognized at the federal level. LLC is a state level entity selection. If you're a sole proprietorship, that means if you're LLC and you're sole proprietorship, that means that when you filed your LLC, you filed as a single member. You had one member. It's going to default to sole proprietorship. That means you will file your LLC on your Schedule C, your individual tax return, Schedule C, as an individual. If you had two or more people when you formed your LLC as members, you're going to default to partnership. That means you would have to file a partnership return. That's the automatic default. But you still have the ability to say, I want to be taxed as an LLC filing as an S Corp, or I want to be taxed as an LLC filing as a C Corp. Make sure you understand those differences and when it's best to file different types of entities. We'll have additional trainings on that and different master classes, so make sure to stay tuned. And we also have information about that in some of our social postings. So on the home office tax deduction, the actual cost method, if you do actual costs, that means you have to keep track of all of your expenses related to your home office, which would include home insurance, your security system, utilities, internet, telephone, HOA dues, rents if you're renting, real estate taxes, mortgages, and many more. There are many more deductions that you can take as well if you are in your home office. So make sure you understand the actual method. Now, the actual method allows you then, if you don't have a profit in your business, as we talked about, to roll forward those different expenses until the year that you do have a profit. In the simplified method, which really started in 2023, it was allowed by the IRS because the IRS really wanted to relieve business owners of having to keep all the records. So you don't have to keep any records, but you are limited to $5 for every square foot of your home office space. And remember, we talked about the home office could be storage in your garage or a separate facility. It's capped at 1,500 and it's up to 300 square feet is what you can deduct.
Again, it relieves you of having to keep the records, but there's no carryover expenses. So if you don't have a profit in your business, the simplified method would not be the method that I would suggest because there's no carryover of those expenses for you. On the internet deduction, what you need to be aware of is that you can do some work at home, and most people are working from home and they're using the internet, but you don't realize, okay, what percentage of this monthly internet expense is deductible? Some of it could be 100% could be. It really depends on your usage, and how you deduct those internet deductions are important as well. There's different methods for proprietorship, corporations, or partnerships. That's why it's important to really understand your structure. And if you just hear something, say if you hear it or you see it on an Instagram post or Facebook post, but you don't really understand, there's different ways to take deductions depending on the type of structure that you're in. So the sole proprietorship, you could either report it on your Schedule C as a line item deduction, or you can report it on your Schedule C as a home office deduction. We're going to talk about the different ways based on the entity structure that you can deduct the internet. So the Schedule C, you can claim on the home office. It tells you where to report it, what line, and then also on the home office deduction, if you want to claim it just as a part of your utilities, then you would do that as Schedule C, line 25. So deductions when you operate a partnership, it's different. There's two different ways. You can deduct the cost as unreimbursed partner expenses, or you can get a reimbursed tax-free from your partnership. Two different ways there. That's why it's important, if you are preparing your own tax returns, you really need to know the proper way to report. And there could be various ways and various benefits of reporting each way. When you own a corporation, there's different ways as well. The corporation would reimburse you for the deduction. So if you are a C Corp or S Corp, you would get a reimbursement from the business. The business simply pays you just as you would if you were working for someone else. You are working for yourself. You're an employee. So it's an employee reimbursement that is a tax-free reimbursement. So substantiating that, it could be important because the IRS may feel, we know that you're not using your internet only for your business unless you have a separate line internet service just for your business and you're using it at home. You may be using some of that personally. There are apps. You can Google apps on software that will track your internet use if you really want to be very specific on your business use. If not, I definitely suggest keeping a log maybe for 2 months on how you're utilizing it at the time, and we can extrapolate and figure out how much for the year you're using your internet to get the business percentage. Let's talk about meals. And when we talk about meals, they're limited to 50% of the total expenses. So food for employees furnished on the business is no longer 100% deductible. It's 50% under TCJA, which is Tax Cuts Job Act. Meals provided to certain employees for convenience of the employers, 50%. So that means, say, for instance, you work in a factory and something is going on at the factory, you own the factory, you're manufacturing, and the employee cannot stop. So if the employee cannot stop working and the employer provides meals in, that's a 50% deduction because that's the benefit of the employer. It benefits the employer for the employee not to stop working. Office parties remain 100% deductible. So remember, this year, you have the opportunity to have various office events and have them 100% deductible. We talk about meals and having meals that are the benefit of the employer. So it also can benefit the employee. That could be a great way to hire, and a benefit for the employee is to have a meal and to bring in meals. So make sure that you look at that. It's a use of a tax-free benefit, and it's a proven way to help keep good employees. So that could be one way when you think about tax-free benefits to the employee. Also, you may think of other things such as the 401k plans or some type of retirement profit sharing where they get a profit of the business. So that incentivizes the employee to really do well. Also, we want to think about, of course, vacation, holidays, bonus pay, and we may also think about health insurance. Okay. So some types of tax-free benefits, we talked about the health insurance and paid vacation. And then, of course, now we're talking about lunch, some different free meals that you can have. The deduction is scheduled to end in 2026. So if this is a perk you want to give your employees, the time is now. But just realize that everyone may not qualify for the tax-free treatment. The IRS may feel like with DoorDashes and the Uber Eats and how people can get food delivered now, they may feel like this is something that you cannot do because it's not really benefiting the employer because the employees can get food. Okay? Now, this is how to pass the convenience test and to establish ways they can get their own meals without a reasonable time. So this is saying the employee cannot go out and get a reasonable meal in the time that they're allowed. So if they have a 15-minute break, it may not be enough time for an employee to get a meal. So this is what we need to substantiate to make sure you're saying why it is a benefit to you and what will prevent the employee from being able to get the meals. Entertainment. Entertainment is no longer 100% deductible. So things like sporting events, tickets, plays, deep sea fishing, they are not deductible. But remember, we talked about ordinary and necessary. If your business is in concerts, so you put on concerts, then you going to concerts could be a deduction because it could be research and development. It could be networking opportunities, but you need to document those things. If you are into deep sea fishing, or you have a business that is a guide for deep sea fishing or teaching techniques, then deep fishing, you going on those deep fishing trips would be, because it's ordinary and necessary. That could be a deduction for your business. That's why it's important to really work with an accountant, a tax preparer who understands your industry, because they would know what's ordinary and necessary in your industry. They also will know what tax courts have said and allowed for different deductions. So that's important.